Hello, everyone. Today, we're diving into Australia's current economic landscape, predictions on interest rates, and what these factors mean for the months and years ahead. We'll be looking closely at inflation, interest rates, lending conditions, and even some global influences, all to provide you with a clear understanding of what we believe lies ahead for the Australian economy. To start, let's examine the current economic climate. The RBA's cash rate is sitting at 4.35%, unchanged since September. The Reserve Bank of Australia is watching inflation carefully, which has come down from last year's highs but still sits at around 3.8%, above the RBA's target of 2 to 3%. We believe that inflation will continue to ease. However, it's still putting pressure on consumer budgets. The current rate environment, combined with slower consumer spending, is expected to keep the RBA cautious for now. We'll look at why these conditions mean we're likely to see stability in rates through early 2025. Next, let's talk about inflation. Over the past year, inflation has moderated significantly, moving from 7.8% in 2022 to around 3.8% recently. Fiscal measures such as energy rebates have supported this reduction. But core inflation, the trimmed mean, is forecast to end the year around 3.5%. Which shows progress, but not quite within the target range. As you can see from the chart, inflation is projected to decline slowly, allowing the RBA to hold rates steady while watching for consistent signs that price pressures are easing. Looking ahead, what does the rate environment look like? The general consensus among economists is that the RBA will hold rates steady until at least early 2025, depending on inflation trends. According to Westpacs' forecast, the cash rate could gradually decrease to around 3.35% by the end of 2025 if inflation aligns with targets. In terms of policy, this will likely mean smaller incremental cuts, with possible 25 basis point reductions starting from Q1 2025. For borrowers, this would signal a gradual easing of financing costs and could be a significant driver of renewed activity in the property market. Here we have Westpacs' detailed interest rate forecasts for Australia, the United States and New Zealand through to the end of 2026. As shown, Australia's cash rate is expected to gradually decrease from its current 4.35%, with cuts anticipated to begin in early 2025, reaching around 3.35% by late 2026. This aligns with Westpacs' view that inflation will continue moderating, allowing for a cautious easing cycle. For the US, rates are also expected to decline, albeit more gradually, with the Fed funds rate forecasted to reach 3.375% by 2026. New Zealand follows a similar path, with cuts projected from 4.75% to around 3.5% by the end of 2026. These synchronized rate paths across major economies highlight a broader move towards easing as inflationary pressures stabilize globally. The forecast also includes swap and bond rates, showing a steady decline over the period, which will influence borrowing costs and investor sentiment in both short and long-term debt markets. Turning to the property market, we can expect some shifts as rates begin to ease. Housing finance has already shown modest month-over-month growth, and price growth in single-home constructions is projected to continue steadily. For the lending market, business credit is stable, reflecting cautious optimism among businesses. As financing costs ease, we expect more favourable conditions for both property buyers and developers, with demand strengthening in response to lower rates. Our economic outlook wouldn't be complete without a look at the global picture. The US, for instance, has posted strong Q3 GDP growth at 3%, which reinforces confidence in global markets. However, Europe and China face their own economic slowdowns, which could impact Australia's trade prospects. Australia remains in a relatively strong position, but the performance of our key trading partners will be essential to watch in the coming year. To conclude, it appears the RBA will continue a cautious approach, holding rates steady until inflation aligns more closely with targets. By late 2025, the cash rate may ease, providing gradual relief for households and the property sector. This steady, careful approach aims to stabilise Australia's economic outlook, while preparing for a more supportive environment for investment and growth. The message here is one of balance and steady recovery,